recording. Okay, so today's class, we're going to discuss something called interest rates. And the price of bonds. Okay, can you guys see the screen? Is there any issue about anything that you want me to tell, you want me to know before I start off the class? Are we good to start? Any discussion, anything that you want to sort of any issue with sound or anything that is happening? So guys, so if everything is sorted, let's look at, we say that when the price of bonds go up, your interest rates fall. So in other words, there's an or in other words, when the, let me write it one more time. When the interest rate falls, let's do this. When the interest rates fall, the price of bonds, we say, go up, and vice versa. When the interest rates rises, so when the interest rates go up, the price of bonds go down. In other words, what I'm saying, there's an inverse relationship. We're saying that there's an inverse relationship between the price of bonds and interest rate. So I want to explain that concept. Okay, why is there a inverse relationship between the price of bonds and interest rates? So before I do go on, somebody's asking me because so yes, you're right, so sorry. So price of bond should fall, you're right. So when the interest rates rise, price of bond falls. When the interest rate falls, price of bond rises. So there is an inverse relationship, you're right. Thank you, Arvind. So what's that? Why is there an inverse relationship is the next question we need to ask. So let's just look at it before we look at our notes. But basically what we say, when the interest rate fall, let's say if the interest rate was interest rate from now onward, we say interest rates as R. Okay, let's say interest rate fall to 5%. Okay, but let's say I also have a bond. Okay, remember a bond has a face value, let's say of 100. There is a rate of return, let's say 10%, and then there is a tenor or duration or tenor of, let's say, 5 years. So अगर आपके पास एक बॉन्ड है जो 10% का है, जो हर साल आपको every year is going to give you $100 that you've given as a loan, it will give you $10 return. What if interest rate goes down to 5%? So if interest rates fall, can I say this, that suddenly when the interest rates go down, a bond that gives you a 10% return will have a rise in demand. A lot more people will be demanding something that gives you 10% return because interest rates are lower than the rate of return on the bonds. So if interest rate goes down, we say the demand for bonds or government securities will go up, which are giving a return higher than 5%. Does that make sense? So demand for bonds will go up because people will be like, when interest rates are going down, the price of the demand for bonds which are giving you better return will go up. And when the demand for bonds go up, we know this, when demand goes up, price of bonds go up. So we say the price of bonds will go up. Why? Because of the fact that you are looking at this scenario where people who are holding that 10% bond can now sell these bonds for a higher price. By the way, there is a thing that we need to understand about bonds. Bonds are just like shares, which means there is a secondary market in which you can buy and sell bond. अगर आज मैंने bond लिया और मैं 2 साल से अपने पास 10% वाला रिटर्न वाला बॉन्ड मेरे पास रखा हुआ है, कल अगर मैं मार्केट में जाकर इसको बेचूं, I will be able to sell it in a market very quickly, just like any stock. Just like any stock, I can sell my bond as well. And the price of bond is basically a function of or depends on what the interest rates are. If the interest rates are too low, then the price of bonds will be high because people will be demanding bonds because interest rates in the banks are very low. So similarly, when the interest rates are high, when the interest rates go up, let's say to 15%, will you demand a bond that is giving you a 10% return? And the answer is no. You will not be demanding a bond that is giving you 10% return, because if the interest rates are going up to 15%, we'll say the demand for bonds will go down. And because of that demand for bond going down, the price of bonds will go down. So when the interest rate goes up, price of bond go down. Mariam is bonds return fixed or changes? Bonds return is fixed. It will give you a fixed return that is promised, which was basically अगर आपने $100 का बॉन्ड लिया है तो आपको वो 10 रुपए देगा हर साल, और 5वें साल आपको वो 10 रुपए भी देगा और वो आपको वो 100 रुपए भी वापस कर देगा. You when you at maturity you will get your $100 plus the interest for that year, and that's how you will get it back. So we say when the interest rates go up, people start demanding more of these bonds with a higher rate of return, and the price of bonds will therefore go up. Similarly, when the interest rates when the interest rate goes down, the price of bonds will go up because people start demanding more of bonds. When the interest rate goes up, the demand for bonds will go down, and therefore people will start demanding less of these bonds, and the price of demand these bonds will go down. Sajil is saying demand for bonds with return lesser than 15% will go down. Exactly. Any bond. In fact, let's talk about this bond. With this bond that we have, has a less than 15% return. So when the interest rates are falling, this bond becomes like very valuable. When the interest rates are rising, this bond becomes less valuable. So we say people. By the way, this is just one example. The idea is that if the interest rates are more than 15%, then the bonds which are giving you more than 15%, they only those will be in demand. But the idea is that in general, when the interest rates are falling, bonds become more favorable and price of bonds will go up. When the interest rates are rising, bonds become less favorable, their demand will fall and therefore price will fall. If the rate of return is equal to interest rate, of course, then there is a deadlock here, because the bonds are giving you equal return, then basically there's no preference whatsoever. But I'm assuming that interest rates, if they are falling below the rate of return, that's what will be there. And by the way, if the rate of return is equal to interest rate for a particular bond, then all those that are above versus those are less will have a different kind of scenario. Okay. So अब देखते हैं एक और part, because this after this part we can talk about what about speculator. Remember, speculator is somebody who has a different kind of a structure. A speculator, he buys low and he sells high. Okay, now we're going to look at speculators perspective, because अभी speculator करता क्या है कि जब कभी bond की price गिरती है तो he's going to be buying a bond, और जब कभी bond की price बढ़ेगी he will be selling bond. In other words, he is holding bonds as financial assets, and he is only going to buy when the price is low and sell when the price is high. So when the price of bonds is going up, what should the speculator do? My question to you guys, if you can write me the answer: if the price of bonds is going up, and if you're a speculator who's holding bond, what should you do? Anyone who can answer me, what should you do? You should be, if you're a speculator, you should be selling. If the price of bond go up, you sell bonds, and when you sell bonds, of course, when you give bond to people, people will give you money. Your money or demand will rise as you hold more cash. Similarly, when the price of bonds are going down, a speculator will buy bonds. Why is he buying bonds? सारी दुनिया जो by the way बेच रही होगी, ये बंदा जो है ना वो खरीद रहा होगा, because he's the one who is buying when the price is low. And when he's buying bonds, his liquidity, or the money that he's holding, the liquidity in his hands will go down. In other words, money demand, I should say, the best way to say this is he will be holding, hold less money balances. Okay, that's basically a better word to use, because I know what your questions will come. And I should say here, when you sell bonds, you hold more money balances. So what we say is that if you are somebody who's a speculator, when the interest rates are going down, I'm going to say this. I'm going to sort of when the interest rates are going down, I'm saying this, that you will be holding more money balances because you are selling bonds. And when the interest rates are going up, you are actually buying bonds, and that's why you're holding less money balances. And the reason is very simple, because if the interest rates are going down, price of bonds will be going up, and this is the time when the speculator will be like, let's sell bonds to people. And of course, when you give them bonds, they give you money, and you will be holding more money balances. So in other words, the way the diagram looks like is that when you remember the speculative demand for money, in the speculative demand for money, we came up with this idea that the speculative demand for money looks like this. So speculative demand for money may, we said this, that it looks like this. Okay. We said this, when the interest rates are high, you are holding less money balances. Remember, speculative demand means you're a speculator. When the interest rates are high, you are holding less money balances. When the interest rates are low, you are, let me call this Q1. When the interest rates are low, you are holding more money balances. So why is that so? Because when the interest rate goes down, we are saying the price of bonds go, when the interest rate goes down, price of bond goes up. And when the price of bonds go up, because the demand is going up, the speculator will be selling bonds. Remember like this, he will be selling bonds. And when he's selling bonds, he's holding more money balances. But when the interest rates are going, when the interest rates are high, so let's call this interest rates are high. Let's call this interest rate high versus R low. Okay. When the interest rates are high, the price of bonds is low. And when the price of bonds is low, speculator is buying bonds. And if he's buying bonds, he's holding less money balances. So in other words, this is another explanation of what we call our speculative demand for money. High interest rates may, speculator will be buying a lot of these assets and so on, and therefore उसके पास कम money balances होंगे. Low interest rates में he will be selling bonds and all that, and that's why he's going to be holding more money balances. Does that make sense, guys? That's it. Also is a reason why we have a downward sloping speculative demand for money. Any questions before we move on? Mariam is saying, does that depend on interest rate? Yes, Mariam, that depends on interest rates. High interest rates, speculator is buying bonds because the price of bond is low. Low interest rates, speculator is selling bonds because price of bonds is high. Are we good? Any questions? If it's sorted, then I'm good to move on. Okay, I am going to take your silence as sorted. If you have a question, you can ask me later. I'm going to move on. So guys, this is what we did right now. हमने अभी यूज किया है वो है interest rates and price of bonds. उसमें we discuss speculative demand, which is page number 95 from our notes. We discuss speculative demand, and we discuss this diagram right now, which is that when the interest rates are high, the price of bonds is low, you buy bonds. When the interest rates are low, the price of bonds is high, and therefore you are selling bonds, speculative selling bonds. Okay, so this is the thing that we just discussed right now. Now I'm going to talk about a very important concept which is called liquidity trap. Okay, so let's write. I'm on page number 96, and we're going to look at liquidity trap. Okay, so liquidity trap, guys, is a very important concept. You will see a lot of MCQs, or sometimes even in a essay question you may need to talk about liquidity trap. Because the reason why it's important is because remember अभी तक हमने जो जब हम बना रहे थे अपना liquidity preference curve, when we were making our liquidity preference curve, if this was my liquidity preference curve LP naught, and I said that what if demand for money goes up, and I said demand for money goes up, my liquidity preference curve will be looking like this one, LP1. So why is the shape of liquidity preference curve like this? Like, why does it happen that it doesn't go like, if this is R naught as an interest rates, it doesn't go below R naught. At certain interest rate, it just becomes like flat, like this kind of a curve. It's a non-parallel kind of a shift. So even if demand for money goes up, for whatever reason demand for money goes up, let's say frequency of payment change हो गई, या GDP बढ़ गया, या कुछ और हो गया, but whatever the reason demand for money goes up, you will see the demand of money to go up in a non-parallel manner. There is a certain interest rates on which it becomes completely elastic. So this is my interest rates. So let's draw this diagram. Interest rates and the quantity of money. And the reason why this happens is because of liquidity. The explanation of why this happens is because of liquidity trap. Is because of liquidity trap. So I want to explain the concept of liquidity trap, and I want to explain why the shape of your liquidity preference curve look like this. Before I do that, do you guys have any question? Any question before we move on? Okay, so why is the shape of your liquidity preference curve like this? So I want to read this note. According to Keynesians, they say the speculative demand for money is highly responsive to changes in interest rates. So they say that it's very responsive to change in interest rates, and basically, if people believe that the rate of interest rate will rise and thus the price of bonds and other securities will fall, few people will want to buy them. So I want to show you this because may not make sense, this paragraph, unless we explain this diagram again. So I'm going to draw the diagram and explain this explanation as to what is happening. So let's say right now my money supply is like this. Okay, my money supply is MS naught, and let's say this is my money demand. Okay, this is my liquidity preference curve, LP naught. So what I'm saying is this, guys, that if there is basically money supply is at this point, and let's say currently right now the interest rates are not. Okay, let's say government says this, that let's increase money supply. Government says let's increase money supply, because when we increase money supply, by the way, look at this, guys. This is MS. Let's call it MS1. Let's call this MS1, and let's draw an MS naught as well. Let's increase money supply from MS naught to MS1. If you increase money supply from MS naught to MS1, you will agree with me that if you increase money supply from MS naught to MS1, your interest rate will fall from R naught to R1. Isn't that true? So when you increase money supply, you can see that the interest rate is going down, right? When the money supply goes up, interest rate goes down. And let's say government is doing this because when the interest rate goes down, they know that C will go up and I will go up, because like the cost of borrowing is going up, cost of borrowing is going down, incentive to save is going down, and therefore C goes down, I goes down. So therefore your AD goes up, and therefore your GDP goes up. This is the intention when the government increase money supply. They want basically, remember, this is what we call expansionary monetary policy, right? So when your money, we learned this in our AS that it is called your expansionary monetary policy. यस खैर देयर विल बी इन्फ्लेशन, बट अभी हम इन्फ्लेशन की टेंशन नहीं ले रहे, अभी हम सिर्फ सोच रहे हैं कि गवर्नमेंट ने कहा कि मनी सप्लाई बढ़ानी है और उसकी वजह से इंटरेस्ट रेट गिराना है, बट गवर्नमेंट ने कहा मनी सप्लाई बढ़ाते हैं, उसकी वजह से इंटरेस्ट रेट गिराएंगे, इंटरेस्ट रेट गिरेगा तो कंजम्पशन बढ़ेगी, इन्वेस्टमेंट बढ़ेगी, एंड देयरफॉर जीडीपी भी आपका बढ़ जाएगा. ऑफ कोर्स इन्फ्लेशन हो सकती है. From the diagram only you said, look at this. So if you are here at point A, right now the equilibrium be at point B, because when the money supply went up, your equilibrium interest rate is going down. So that's why it happens. Make sense? Now, government ne bola, now let's look at, guys, let's move on to liquidity trap now. So we know this, when the money supply goes up, interest rates goes down. Government ne bola, yaar, mazid interest rate girate hain. What if the government decides to make the money supply go down further to MS2? If the government decides to increase money supply further, this is what the Keynesians argument is. Keynesians say, so this is what Keynesians argument. Keynesians say if the money supply goes up too much, there could be a possibility of liquidity trap to happen. Okay, so remember, this is your interest rates, and your quantity of money. So what they are saying is that there could be a possibility of liquidity trap happening. What do you mean by this? अगर आपने money supply बढ़ाई, guys, if you increase money supply, there could be a possibility that the interest rates are probably at R1. And the interest rates, for example, if our interest rate R is too low, if interest rate is too low, according to, let's say, everyone, let's say interest rate is so low that people are thinking कि यार इतना नीचे है, it's so low that it can only go up. If interest rate is low, too low, that people assume that it will only go up, then one could argue this, that price of bonds will be so high that it will only go down. You guys get that? कि अगर आपको मैं बोलूं कि interest rates are so low that it will be, yes, exactly, in Japan it happened, exactly, Hamza, that interest rates became so low, interest rate was almost 0% in Japan at one point in time, and interest rate became so low that people were like, it's so low that it will only go up, then of course the price of bonds will become so high that it will only go down, because people are like, when the interest rate is super low, price of bond is high. अभी हमने सीखा था थोड़ी देर पहले. So if interest rates are really low, price of bonds is going to be really high. And if it's really high, then it will only go down. And if the price of bonds are only going to go down, will you buy bonds? If I tell you guys the price of bonds will fall tomorrow, will you buy bonds today? No, exactly. So what Keynesians argue is that if the price of bonds will fall tomorrow, people will not buy the bonds today, because they'll be like, if I buy it, kal to uski price ginni hai, so I'm not going to buy it. So what Keynesians argue is this, that there comes a point when the money supply is going up and people stop responding to the change in money supply, rather than buying goods, because like when the interest rate goes down, the price of bonds will go up. They are saying here interest rate itna gir gaya that people will not going to buy. So what happens basically is that when people stop buying, let me write this, price of bonds will be so high that it will only go up. People stop buying bonds and other financial assets, and they start holding the excess liquidity, Why do we have this excess liquidity? Because money supply is going up. The money supply that went up, the government thought that I'm going to increase money supply. People, the money supply going up means that people are going to sort of buy more of things. People stop buying because they'll be like, you know what, this is a bad situation. This is a situation where if I buy more of the bonds, they will only go down. You know, a good example of this is like when the property prices are super high, should you be buying a property? And the answer is no. Why? Because if you buy the property, uh, and if the price is super high that it will not fall any further, then you will be basically holding a very expensive property. You only buy to sell it at a higher price tomorrow. But if the price is so high that it can't rise any further, this means that it will only go down. And if is going to go down, you're not going to buy. And if you're not going to buy, you will keep on holding money balances, which is exactly what happens. According to Keynesian, the at very low interest rates, people are not going to respond to any changes in money supply, and there comes a point where the interest rate become too flat. Interest rates are not falling any point below, because at this zone people are not failing to respond to changes in money supply. Normally a rise in money supply will make people to buy more because interest rates are going down, but then comes a point after B where a rise in money supply is not making people to buy any further because they're holding money balances, in your demand for money becomes perfectly elastic. And that is basically called liquidity trap. When the interest rates according to people are too low that they can't fall any further, then the price of bonds are too high, they can't rise any further, and as a result people are not buying those bonds or financial assets, and they're holding this excess liquidity, which is basically causing money supply to go up. And I want to show you this example here, that like with a very shallow LP, look at this guys, with a very shallow LP, which means very flat LP, a rise in money supply from MS to MS dash will only lead to a small fall in interest rates from R1 to R2. Once people believe that the rate of interest will not go any lower, any rise in money supply, because now अगर आप money supply बढ़ाओगे, any rise in money supply beyond R2, you know this, that uh, will have no effect on interest rates. The additional money will be lost in what Keynesians call the liquidity trap. People simply hold these idle balances. They're simply buying these idle balances because they are holding these idle balances because they don't want to spend any further. Yeah, what I wrote here is this: people, I said people stop buying bonds and other financial assets, they start holding excess liquidity. So जो money supply बढ़ रही है आपकी, this is exactly what I'm trying to explain, Mariam. Whenever money supply went up, this excess money, they are holding these balances because they're saying that there's no point of buying. Look at this: the additional money will be lost in what Keynesians call the liquidity trap. And what people are doing is they're simply holding additional money balances. They're holding money balances primarily because they know there's no point of buying. You buy today, the price will fall tomorrow, and then you will lose out any gains. So for you, there is no point of buying because of the fact that the prices are too high. So when the prices are too high, uh, remember deflation. Remember deflation from our AS economics. We said this. Why does deflation happen? Because people are assuming that the price are going to fall, and that's exactly what happens in liquidity trap. When the interest rates are too low, there could be a situation where the deflationary effect could happen, where people are not spending because they assume the price will fall further. And that's exactly what Hamza Raja said, that Japan faced this kind of situation. And I wrote it here, guys. um, I want to read this paragraph for you. Keynes himself saw the liquidity trap as merely a special case, the case in which economy is in deep recession. So in a liquidity trap, you are in a deep recession. In such a case, any increase in money supply or expansion of money supply would have no effect on the economy. In more normal times, when money supply goes up, you will see interest rate to change and therefore economy to change. But in this case, when you are in a recession, that is basically the situation which is bad. The Japanese economy suffered from a prolonged recession from the 90s to the early 2000s, where they saw that the government was trying to increase money supply, but people were not willing to spend. People were simply not spending because they were like, if we spend today, the price will fall tomorrow. They in fact decided to hold these money balances, and the interest rates were almost very negligent to very as low to like almost 0%, and people were still not spending money because they'd be like, you know what, the interest rates are so low, they will only go up, which means price of bonds are so high, they will only go down, which means that you are almost at a case where you are not spending at all. Does that make sense, guys? So this is the case for liquidity trap, that your demand for money, your demand for money becomes completely flat. And that's why we came up with this diagram. We said demand for money becomes completely flat in this zone, which is what we call your liquidity trap is happening. Do you guys get that? Does that make sense? Any questions, guys? If there are no questions, then what we need to do is basically look at this concept. I want to sort of so basically we are done with page number 98. uh, we're going to look at this money supply and monetary transmission in tomorrow's class. Tomorrow I have a class from 10 to 11 as well. Tomorrow we meet from 10 to 11 to discuss our the rest of the chapter, and tomorrow is a good day to also do the worksheet. So I'm going to sort of make you guys do that worksheet. If time permits, we're going to have a 1 hour class, and we will discuss both the rest of this chapter and the worksheet that I just sent you today. And then we'll be done with chapter 6. So that's what it will be. Okay, guys, I'm going to also send the recording to you guys. So this will be uploaded as well.